Walk us through the good, the bad. Why is the stock down more than 2%?
Yeah, Bailey. I mean, today was actually quite a funny day. I mean, Goldman Sachs reporting earnings, the first among big banks, which is, as you say, is very, very rare. And obviously at a moment where, Iran is top of the agenda, private credit is top of the agenda, AI is top of the agenda, there's just a lot of chaos to happen, regardless of who's reporting first. And for Goldman to go first and alone on the first day, David Solomon hasn't had the best day today. He's even lashed out at the research community, by the way. On the analyst call today, he said, one of the biggest misses in the headlines that came out today is that the bond trading desks and the rates traders, the FICC department, basically the FICC division of Goldman Sachs, missed expectations of analysts by $800 million. So instead of posting about 4.8 billion for the quarter, they actually posted about 4 billion for the quarter.
Big difference.
It's a big difference, and it's a drop on last year. It's a surprise drop. Not just missing analyst estimates, but actually lower than the same quarter in the previous year. And one of the things that he says is that actually, this was our 10th best FICC quarter ever. A lot of this has to do with expectations that are set in the research community. David Solomon said.
Is he right?
Well, I mean, perhaps, but I mean, you can't always blame these analysts for not knowing exactly how the trading volatility is going to plan out and what Donald Trump is going to say tomorrow and what that's going to happen to Citadel and Millennium and what they phone up their banks to want to do.
I thought management teams, though, were supposed to talk to the analyst community and it's kind of like behind closed doors be like, hey, maybe you take this number down a little bit.
They do. But I guess to be fair to everyone in this case, right, like this is a quarter where we've seen like intense volatility in different directions. You've seen blow-ups, big trading blow-ups, which potentially you think that's good for banks, then you think it's bad for banks the next day because some hedge fund pod has blown up and you don't really know. You don't have great visibility into that when you are dealing with so many trading firms that are private, and most of the intel that you're getting is through Bloomberg reporting most of the time.
How much is it, though, expectations? I mean, this is a stock that was up 53% last year. I mean, almost 50% the year before, right? Yeah. Like we've seen these big banks do really, really well. So how much is it just maybe, expectations,
like sell the good
valuation?
news, right? Yeah, exactly. And I mean, you're right, Carol, to some degree. Yeah, all the banks did really well last year. Someone's looking for a bit of froth to pop, to start settling again. So maybe today is the day that happened to Goldman Sachs, but we'll see the rest of the week whether that's going to happen to the other banks as well. But look, you've got JP Morgan reporting tomorrow, Citi reporting tomorrow, Morgan Stanley Wednesday. We'll see.
Well, are these banks going to be kind of addressing the elephant in the room that is private credit?
Yeah, Bailey. I mean, I think the elephant in the room for like half of Bloomberg might be private credit. I think if you phone the executive teams of Goldman Sachs or Citigroup, I think a lot of them will start moaning to you and like trying to hang the phone up at you.
But they have exposure.
They do have exposure. And I mean, Goldman Sachs, its own private credit fund. I mean, Goldman Sachs has its own asset management arm, which is very big, unlike most of the other big banks. And that unit itself, one of its funds, narrowly escaped a redemption cap of 5%, which would have meant all sorts of other things that Blue Owl and other firms were exposed to as well. So they're just kind of eking out here. But crucially, yes, you're right. The back leverage that a lot of these private credit firms have, a lot of these private credit firms borrow from big banks and then lend on to, potentially less reliable borrowers in the wider market. And that's where some of the blowups have been. So being able to understand and fully understand tracing that, the exposure that some of these banks have is one of the things that some of the analysts were concerned about today. The banks generally have been trying to put a lid on that kind of worry. And so far, there's that. I think on the retail side of that, David Solomon did admit today that concern is likely to continue on the retail side of things, particularly as headlines continue and potentially, as we've seen pockets of fraud in the market, in the private credit market, and, a surge in redemptions particularly on the retail side. On the institutional side, it seems to be more mellow so far.
Just really got about 20, 25 seconds left. Goldman, tell us anything about what we're going to get tomorrow from JP Morgan and the others?
Oh, and I actually missed the great headline for Goldman, which, by the way, we had to
the $5 billion bond sale?
No. The equities record. So the equities trading record. Okay. The equities traders at Goldman Sachs posted their best 3 months ever of any bank in Wall Street history, which surpassed their last record, which was last quarter, by more than $1 billion. So it was pretty huge. So we'll see stock trading, I think, will be the theme of the week, but maybe FICC of more disappointment.
High bar for everybody else. Yeah.